Hello everyone, hope all of you are doing great. Welcome back to AC 222 Managerial Accounting and Control. This week we will learn about standard costing and variances, and all these are in chapter 11. So we will learn what do you mean by standard costs, and we will also learn different type of variances for three manufacturing costs. And we all know that three manufacturing costs are direct material cost, direct labor cost, and overhead cost. So we will also learn how these three costs can vary from the budgeted one. So we will compare the budgeted costs, and we will also check the actual cost, and the differences we will call variances. So let's first learn what do you mean by standard cost. So standard cost is kind of the benchmark for evaluating your actual cost, and we usually express the standard cost only for a single unit of product. And there are two types of standards. One is called the ideal standard, and in this type of scenario you will not allow any inefficiencies, but in real world you will see you may have some inefficiency, you may have machine breakdown, or you may have some wastage. So basically, when we will think everything from a practical point of view, we'll try to take care of all those inefficiencies, and we will fix a practical standard rather than an ideal standard. And basically practical standards are really attainable, but ideal standards may not be attained in every situation. So let's take one example of this product, which is mission flour tortilla. So to produce these tortilla breads, the manufacturing company must need to spend on these three types of expenses: direct material, direct labor, and manufacturing overhead. So the direct material of these tortilla bread will be the flour, and this you can visualize the direct labor, the people who are working in the factory, and they may have different type of manufacturing overheads, such as the depreciation of their machine, or tax, insurance of, or any other factory related costs. So now if you think of the standard cost of producing 1 unit of product, this whole bulk of this tortilla, we will consider this is 1 unit of product. You could figure it out like this way, that to produce this 1 unit of product you need 5 pounds of flour, which is your direct material, and the standard price per pound of flour is $1.50. That means your direct material cost for one product will be $7.50. You can also think of how much labor you need to spend on to produce this 1 unit of product, and you figured out in an ideal standard situation you need 0.05 direct labor hours, and the labor cost is $22. That means for 1 unit of products your direct labor cost is $1.10. You could also figure out your variable manufacturing overhead and fixed manufacturing overhead. And remember, this type of overhead costs are actually driven by some cost allocation driver. So here machine hours will be the cost driver, and we figured it out that for 1 unit you need to spend 0.1 machine hours, and you also know the cost for these machine hours. $25 is the variable overhead cost per machine hour, and $9 is the fixed overhead cost per machine hour. So if you multiply with this 0.1 machine hours, you figure out that the variable manufacturing overhead cost for 1 unit of tortilla will be $2.50, and the fixed overhead per unit will be 90 cents. And if you add all these costs, you figure out that 1 unit of tortilla bread actually costs $12. So this is the ideal situation, or the standard cost of 1 unit of product. Now if you want to compare the actual cost against the standard cost, you could figure it out how many units you actually produces. So here you found that you actually produces 31,000 units or cases, and you know what would be the cost per case or per unit, which we found in our previous slides, and we are just showing the variable portions first. And then we will multiply all this cost by 31,000 cases or units. So these will be your budgeted cost based on this standard per unit cost, and this is your actual cost. Column C is showing your actual cost. And now you could compare your actual cost against the budgeted cost, and the differences will be your variances. Now remember, all these are costs. So if you see that your actual cost is actually lower than the budgeted cost, it will be a good news for you. That means it will be a favorable variance. So if you compare here for your direct material, for all those 31,000 cases, your actual cost is $224,000. Whereas your budgeted cost for those 31,000 cases would be $232,500. So you see the actual cost is lower than the budgeted one, so the difference will be a favorable difference. Remember, when you find the variances, don't worry about the sign. Just take the absolute difference and then try to apply your common sense and then figure it out whether the difference or the variance is a favorable one or an unfavorable one. Now for the next two costs, which are direct labor and variable manufacturing overhead, you see that for both cases your actual costs are actually higher than the budgeted cost. Since these actual costs are higher than the budgeted cost, so we will call these variances as unfavorable variance. Now, if you try to identify why you actually have these variances, and if you just want to focus on the direct material part, remember the direct material for this tortilla bread is flour, right? Now, why you will have some variance? That means why you will have some differences between the actual cost and the budgeted cost. There might be two reasons. Number one reason could be the price of per pound of flour could be different. That means the actual price could be higher or lower than the budgeted one. And another reason for this variance is that the quantity of flour that you are using. So for your budgeted one, you should have some standard amount or standard quantity of direct material or flour that you already budgeted. But when you're gonna check the actual amount that you actually used or you needed, that could be higher or lower. That means the direct material variance could occur either because of your price variance of your direct material or the quantity variance of your direct material. So we will figure it out, all those variances. So let's try to investigate the direct material variances a little deeply. So here you need to find out the price variance and the quantity variance of your direct material, and you need to know some formula. But I'll give you some tips how to remember all these formulas. So you basically will have these three boxes. That's what I personally prefer to use. Three boxes. Number one box will always show you the actual part. So you see here the first box is the actual quantity and actual price. That means if you multiply the actual amount of flour that you used and what's the actual price you paid for per pound of flour, you will find your pure actual cost. Now if you see the other stream of these boxes, the rightmost boxes is all standard. So it says that standard quantity multiplied by standard price. Standard quantity allowed or standard quantity is all same. So this right hand side, extreme right hand side box is all standard cost based on your standard quantity and standard price, and the left hand side box is the actual cost based on your actual quantity and actual price. And here if you look at the middle box, you will see that if you compare the second box with the first box, you just change the price. In the first box, both of these components were actual quantity times actual price. But in the second box, instead of using the actual price, you are using the standard price. So if you compare this first and second box, you see the main difference is here is the price. The first box is using the actual price, the second box is using the standard price. And that's why the difference of these two boxes will be called as a price variance. And this is the direct material price variance. Now if you compare the second versus the third box, you see that in your second box it's actual quantity times standard price, whereas the third box is all standard quantity and standard price. That means if you compare box number 2 versus box number 3, the main difference is the quantity. In box 2 we are using actual quantity, and in box 3 we are using the standard quantity, and for both boxes 2 and 3 we are using a standard price. That means the main difference between box number 2 and box number 3 is the quantity. So the difference of this second and third box will be known as the quantity variance. And if you add both variances, that means the price variance and quantity variance, you'll call it as total variance. So this is one tip how you can remember all these formulas and how you can write down all those boxes when you're gonna solve your problem. Again, you can express this formula in an equation format. So that means if you look at here for the price variance, what is this? The first box versus the second box. First box means AQ times AP, and the second box means AQ times SP. That means actual quantity times actual price minus the actual quantity times standard price. And if you take this actual quantity out, then you can put these both prices within bracket, actual price minus standard price. This is how you can modify this formula and you can use it in an equation format. But remember, don't try to memorize all those formulas blindly. Rather, try to understand the concept behind all these formula. That it will be helpful for you to know, to understand, to memorize all those formula. Now again, if you check at the quantity variances, excuse me, you will see here that AQ times SP minus SQ times SP. So if you take SP out, you will have AQ and SQ within your bracket. And here the main difference is the quantity, so you're gonna call it a quantity variance. And you can also express it in a short equation format, and this is how you're gonna calculate your direct material variances. Now let's take a look at the direct labor variance. So for direct labor, you will have again 3 boxes. We're gonna compare. The first box is all actual, and the third box is all standard, and in the middle we are just taking one actual and another standard. So now let's try to focus on these components. So for direct labor, we actually don't call the price of labor. Rather, we pay some wages to our workers or employees. And when you pay the wages, we actually check the rate. Right. That means in one sense, the price of your direct labor is the wage rate. And that's why we'll not call it a rate variance. Rather, we're gonna call it as a we'll call it as a rate variance instead of calling it as a price variance. So again, here another thing you have to remember, that when you use your labor, how much labor you are using, we actually don't use any quantity. Rather, we actually check it by using the number of hours that you are using. That means we will also not call like the actual quantity. Rather, we're gonna use this term actual hours and standard hours. So for direct labor variance, again the first box will be both actual hour times actual rate. So that means how many hours actually your labor force worked and what was the wage rate. So the very first box is or the number 1 box is all actual. Now if you look at the second box, you will see that instead of using the actual rate, we are using the standard rate, but we are also using the actual hours. So here the main difference is the rate, actual rate versus standard rate. So the difference of these two boxes will be known as the rate variance. On the other hand, if you compare box number 2 versus box number 3, you will see in box 2 it is actual hour times the standard rate, whereas in box 3 both are standard. That means standard hours times standard rate. That means if you compare box 2 versus box 3, the main difference is actually the hour. One is actual hour and another is the standard hour. So how many hours you actually spend to produce a specific product actually also defines the efficiency of your labor force. So the difference here, we'll call it as an efficiency variance. I'm repeating, efficiency variance is the comparison between box number 2 and box number 3. And here in box 2 and 3, the main difference is your hours, labor hours. In box 2 we are using actual hours, versus in box 3 we are using standard hour, and for both cases we are using the standard rates. So the main difference is here the hours, which actually defines the efficiency of our labor force, and we will call these differences of this box 2 and box 3 as an efficiency variance. So again, you can express it in terms of an equation format. I also posted a formula sheet on Blackboard. Please check that one. That will be helpful for you to know all these formulas together. So this is actually the summary of your direct material and direct labor variances. And again, these are kind of the formula or equation format of those boxes, but I personally prefer to draw boxes when I solve the problems. Now we'll focus on the manufacturing overhead variances. So remember, manufacturing overhead cost could be either a variable manufacturing overhead cost or it could be a fixed manufacturing overhead cost. So when you need to find out the manufacturing overhead variance, you actually need to check whether the problem is asking about the variable portion of your overhead or the fixed portion of your overhead. The variable portion of your manufacturing overhead is actually just like the labor variances, direct labor variances. Again, you will see here 3 boxes. The first box is all actual, and overhead is usually driven by either number of machine hours or number of labor hours. So here you are using the hours, actual hours times the actual rate in your box 1. In box 2 you are using the actual hours, but we are using the standard rate. So the main difference between the box 1 and the box 2 is actually the rate of your hours. It could be the labor hour or the machine hours. In box number 1 it's the actual hour, and in box number 2 it's the standard hour. Standard rates, actual rate and standard rate. So the difference between these first 2 boxes will be known as the rate variance. And for box number 2 and box number 3, you will see here in box 2 we are using the actual hours and standard rate, whereas in box 3 we are using both standard hour and standard rate. So the main difference between box 2 and 3 is the hour. In number 2 it's actual hour, in number 3 it's a standard hour, but both cases we are using the standard rate. So the main difference is the hours, and hour actually defines the efficiency of your machines or the labor forces. So the difference will also be known as the efficiency variance. So it is exactly like the direct labor variance boxes. Now you can also express those in terms of some formula. Now we will look at the fixed portion of the variable overhead variances. And the fixed overhead variance formula boxes are a little bit different, and here you really need to know. So you will see that you will have 3 boxes. Conceptually both all are same. Number 1 box is all actual portion, and the number 3 box is all standard portion, and the second one is the budgeted portion. So, and the names are a little bit different. So if you compare box number 1 versus box number 2, we will call it as fixed overhead budget variance. So in box 1 it's all actual, and you are comparing it with budgeted overhead. So the difference, we'll call it the budget variance, and of course we are talking about the fixed overhead, so we'll call it as fixed overhead budget variance. Now if you compare box number 2 and box number 3, box 2 is the budgeted one, and box 3 is the all standard rate and standard hours. And remember, sometimes fixed overhead could be also calculated based on some allocation driver like machine hours or labor hours, and you should know the rate for all those hours. And here we actually call it fixed overhead volume variance, because the difference occurs just because of the volume of your product. Either you are producing more units or less units, and that's why this difference actually occurs. So the second variance for your fixed overhead cost, we'll call it as fixed overhead volume variance. So these are the boxes you really need to know. And when we'll solve these problems, I personally prefer to draw all these boxes, and that actually helps me to remind the formula. You can also check the formula sheet. Again, this chapter you really know those formulas and should have very good understanding about the reasons and the concepts behind those formula. You can also express it in terms of this equation format: fixed overhead budget variance. Again, for fixed overhead, one we're gonna call budget variance, another we're gonna call volume variance. Budget is the actual fixed overhead minus the budgeted fixed overhead, and for the volume variance is the budgeted fixed overhead minus all standard parts. And this is how we really need to know the formula. And now we will solve some problems.